Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. In this episode, we talk about defined outcome or buffered ETFs. These ETFs allow investors to participate in the market upside to a cap while limiting losses if the market falls. These ETFs are relatively new. In fact, Innovator was the first ETF provider to launch defined outcome ETFs in August of 2018. And we had Bruce Pond, CEO of Innovator Capital Management, on the show in May 2019. And since then, a number of providers have launched these products. More than 100 products are available to investors now, where there were $7 billion in assets. These are so popular with investors. My guest today is Johan Grön, Vice President at Allianz Investment Management. Allianz has been managing defined outcome strategies in an insurance wrapper for their clients for decades. They have a lot of experience in that area. And last year, they launched a suite of buffered ETFs. So with Johan, we'll dive deeper into buffered ETFs, how they work, what they aim to do, and how they should be used in a portfolio. Johan, welcome. Great to have you on the show.
It's great to be here. Thank you.
So stocks have been on a roller coaster ride this year, and lately they are selling off largely on inflation concerns. So I wanted to start with your thoughts on the recent market action. What do you think?
Yeah, it's been interesting. It's we we look at the volatility of the market quite a bit, as you can imagine, like any other investor out there. And I think it's a rare occasion where I can say that I find the market to be what I would classify as being rationally nervous, if that makes any sense. I know today, like even just today, earlier today, we saw the VIX above 25 again. And that's coming off of relatively calm. And I say relatively calm, this is more of a perception statement, relatively calm volatility in April and into the first or so week of May. It's felt like it's been a little bit more stable relative to earlier in the year when VIX was significantly higher at times. So I just want to bring that into perspective because we haven't really seen the VIX itself closing at the 25 level relative to today, right, where it was 25 earlier today. June 1st of last year was one period where it hit 25 as well. That's after the big run up in volatility right after the pandemic started to set in. So back then, and I use that only as a reference point for how crazy it's been. You look back and you would argue that the first half of the pandemic situation after March, April, May, June, markets were classified as being really jittery and nervous, and there was just so much uncertainty, and nobody what to do with that or to how to make heads or tails of it. Nobody had been through this type of pandemic before. So at that point, just a few months after it started, you had a VIX level at 25. That's what you're seeing today. And before today, you've seen levels around the low 20s and so on. That is still significantly higher than what we saw leading into the pandemic, when you saw low numbers in the low teens for an extended period of time. So I don't want the perception can't be that volatility is just here right now. It's been with us for quite some time. And now when you have what I call, again, the rational nervousness, what I'm talking about is the interplay between the inflation fear and the market reactions. That is the one single factor that is driving the volatility for us right now. And even just an hour ago, the Fed released the minutes from the April meeting. And even now it's coming out slowly, even from the Fed. There might be some concern about inflation potentially lasting a little bit longer than what they would characterize as being transitory. And that's what everybody's nervous about, right? You saw the numbers come in April. Everybody said, whoa, this is a little bit of a shock factor. Suspicions about them coming in higher, but not so high, or not as high as they ended up coming in. So now it's all eyes on the Fed. What are they going to do? And they're already indicating, or some of the members are indicating, that if this continues, then they might have to start putting the topic of tapering back on the table, at least as a discussion topic in upcoming meetings. And that's a subtle signal, but nevertheless a signal. So I would say that we're in this. It's a little bit of a chicken race here, where on one hand you see inflation numbers come up for a handful of reasons, with supply chain issues and inventory shortages. Labor market is still, you still have about 16 million people collecting unemployment benefits. There are a lot of reasons for why the inflationary pressure is coming, but will the Fed have the patience to see it through in a transitory way, or will they start tapering or lifting up the rates before we can see this period come through?
Right. So as you mentioned, inflation fears are driving this volatility, and April number was a shocker, but it remains to be seen whether inflation is being driven by all the temporary factors which are related to the pandemic, which is what the Fed says or believes, or we are witnessing a historic shift after decades of ultra-low inflation. And I saw a recent survey by Bank of America. It was the Global Fund Manager Survey, which says that professional investors now see inflation and not COVID as the biggest tail risk for markets. So do you agree? What, in your view, is the biggest risk for markets now?
I would agree. Right now, it's the inflation. Taking aside any potential impact of a mutation that vaccines can't control, and we're back into a global lockdown scenario, that's of course even further out on the tail risk. We would all knock on wood, hope that that's the case. But yes, it's the short answer. Inflation right now, that is the key pivotal point. And it's, if you think about it from a practical point of view, inflation, it comes from a few different sources. If you look at the commodities markets, prices will go up and down, based on supply and demand. So that's a more of an economic driving type of inflationary situation if the economy is about to overheat. But you also have some of these pandemic-related items, whether it's restaurants or airfare or other types of services. Those prices, when they come up, they tend to stay up a little bit longer. And once you get used to charging more and you still get the same number of widgets, if you will, it's more rare to see the prices come back down again. So it's hard to see a future where inflation is going to come back down or slow down anytime soon. And again, it's going to be a question of the duration of this event and how long it's going to take. And as inflation takes hold, you will see upward pressure on the long-term rates, and that in effect will make the equity valuations, they have to reprice accordingly, and you'll more likely see continuous sell-offs in the equity markets if that happens. And now you have this issue of increasing yields while equities are selling off, and it's difficult for an investor to find a place to hide in that case. So it becomes very problematic in terms of how you're allocating assets, which is most individuals and institutions' dilemmas. It's not whether they want to buy a growth stock or a value stock, but it's the decisions that are a layer up in terms of how they're allocating their assets. That's what's really going to impact the expected returns going forward for those investors. And in a market like this, their decision-making process becomes challenged. It becomes very difficult for asset allocators.
Yeah, it's a difficult market for sure. And earlier this year in particular, we saw a lot of rotation into cyclical areas of the market, and last year's biggest winners were under pressure. But there have been days when we see that investors pile back into big tech stocks and emerging technology stocks, which were biggest winners last year. Stocks, cloud computing, video gaming, video conferencing, those stocks continue to be under pressure. So which areas of the market look attractive to you now, and which one should be avoided?
Yeah, it's. I wish I had a straight answer for you on this one, and it is the oscillation between inflation on or inflation off. It used to be risk on, risk off for a variety of factors. Now it's come down to this bipolarism, if you will. If you believe that inflation is going to take hold, you're going to turn to one investment. If you believe that inflation is going to be transitory and come back down and be more muted, then you're going to lean in a different camp. And whether that's on the tech or if you're going consumer, more defense stocks, then that will kind of be a reflection of what you believe in terms of where inflation might be going, and hence the rates and hence the equity pricing. So when we think about this, it's the individual stock pickers game to try to position for that. But for most investors, it's not their day job, and if you invest in the market more broadly, then you're exposed to each one of those scenarios in a more equal fashion. More directly on the tech side, those firms, yes, they've had a huge run-up, and clearly they're helped by the easy monetary policies as well. But the fact of the matter is that a lot of that run-up came from a complete shift in terms of how we work and how much work is being done over WebEx now, for example. And those changes are, for all intents and purposes, permanent to a large degree. Most companies will have changed their business model in terms of communication and meetings and travels already. Now, does that mean that demand will go up? Probably. I would argue that the level of technology and the technological advancement as it relates to communication and effective communication in the business world primarily is going to push further and further out on that frontier of innovation. And that, by effect, will bode well for those technology companies that are living in that space on one side. On the other side, should we have inflation runaway, then that doesn't bode well for them. Regardless of how successful they are, they're going to fight a pretty heavy tide of rate increases at that point.
So let's talk about defined outcome ETFs now. And we have seen a lot of interest in these products, particularly whenever the market is very volatile. Investors pile into these ETFs and these strategies in general. So tell us, what are defined outcome ETFs and why should investors consider them now?
Sure, it's quite interesting. It's a relatively new field. It's been around only for give or take 2.5+ years now, and it's already reached well beyond $6 billion in market size. So definitely a lot, quite attractive. But what it is in essence is a way for investors to participate in the equity market up to a certain cap. So you get equity exposure, but you're capped out on the upside. And in return for that, you have risk mitigation on the downside. So if the market goes down, the ETF will absorb some of those losses. And the cap and this buffer on the downside, they're both terms that are defined and set, and they're in play over a certain amount of time, typically over 12 months. So as an investor, you'll always know how much participation you have to the equity market, and you also know exactly how much protection you have on the downside, and you also know over what period of time this is in place. For those of the listeners that are familiar with structured notes, very similar. It's a structured outcome, with the main difference of these structured outcomes being offered up in a liquid wrapper of the ETF. So again, if you compare it to a structured note, they have a different fee structure. They don't come with any credit risk. You don't have to go to a bank to buy it. You can buy it, through your brokerage account. So it's easy access.
These are definitely very interesting products and make a lot of sense in the current market environment. Please tell us how these ETFs are constructed and what exactly they hold.
Yeah, sure. So they, the underlying investments inside of these ETFs, they're options contracts. So again, you can use options to structure the outcome that you're looking for. And in our case, they are flex options. And all that means is that they're customizable, so you can get the exact payoff that you're looking for. And they're also exchange traded, so fully liquid, and in our case on the S&P 500. So you have access to the S&P 500 in a way that you follow the returns of the S&P 500 over a certain amount of time through these options contracts. And really what it is, for those that trade options and might be familiar with this, it's really a long put spread, and you sell a call on the upside to set the cap. And then you also have options it's called a box trade. You get the options exposure to the index itself. So you have index exposure, and then you have put spread that gives you the buffer level. And in the case of the Allianz investment management ETFs, we have one with a 10% buffer and one with a 12% buffer, and it's in place for 12 months, which means after 12 months, you reset the cap, you reset the buffer, and you can hold the ETF indefinitely if you want to.
So I see a lot of terms that you used: buffer, cap, outcome period, and there are 8 products, 8 ETFs in the product suite by Allianz now. So could you please walk us through the product lineup and also explain the various terms?
Yeah, sure. So maybe starting with the lineup, then we have 2 different strategies, and each strategy comes in 4 different time periods, and I'll get to that in a second. So, but I'll start with an example. So we have a 10% buffer, and the 12-month period for which the cap and the buffer is in place starts on January 1. So if you buy it on January 1, and let's say you have a cap that's 15% and your buffer is 10%, that means that if the S&P 500 over that 12-month period is up by 15% or less, that's the cap level, then you get to keep that full return of the market. But if the market is up more than 15%, let's say it's up 16 or 17 or 18, you get 15, because that's the cap, that's the maximum return that you can gain from this ETF over that 12-month period. And then if the market is down by 10% or less, you're flat as an investor. You don't lose any money over that time period. If the market is down more than 10, let's say 11% or 12%, then you are down 1% or 2%. If the market is down 15%, you're buffered again for the first 10, so you're only down 5. And what that implies is that in every market scenario that you can draw on a piece of paper, you will either outperform the market or, except for one case, and that is when the market rallies and it goes beyond where the cap level is, then you will underperform by that amount. And I mentioned that because it's a risk management or risk mitigating type of strategy first. It's not meant to. It's not something you invest in if you want to beat the S&P 500, on the upside, or hit the ball out of the park. Then you can buy levered ETFs or some different type of asset. But if you're concerned about risk management, and this is a very straightforward way to get that exposure, and knowing exactly what your expectation on the returns will be over a set amount of time. So in terms of the cap, just for definition, it is exactly what it sounds like. You're capped out in terms of how much you can make if you're investing. And the buffer and the buffer zone, that's where you are protected against losses. So as long as the market ends within that buffer zone, then you're flat. You don't lose any money in your ETF. Now, to make it a little bit more complicated, if on January 1, this ETF is resetting its cap and its buffer, you have a 10% buffer, you have a 15% cap, and then 6 months later, the market is up and your ETF is up 5%. You can obviously decide if you want to keep it or if you want to trade it or buy more or sell. You can do whatever you want since it's fully liquid. But if you're a new investor, you also have a decision to make as to whether you want to buy it at that point. So if the ETF has gained or appreciated in value by 5%, you're 6 months into the outcome period, the cap is still 15, which means the gap between the 5 and the 15 is 10. So you can make 10%, but then you hit the cap. But it also means that you can lose 5% before the buffer sets in. That's why it's important to always know where the cap and the buffer is at any point in time before you invest. So to get that information, the easiest place to go is just to go on our website in this case, and it's published every day continuously throughout the day, so you'll always know where it's being priced, so you don't have to have any surprises. And that's part of the value proposition, and it's a pretty slick one, I believe, because you will always know what to expect from this investment, which is the beauty here. It's hard to be surprised if you know what you're buying when you're buying it, and you know what the expectation is and the potential outcomes. And that's why we find that it's been so successful in the market, and one of the reasons for why investors really gravitate towards these type of solutions. It takes a lot of the risk and the ambiguity out of the investment decision, and it makes the expectations management a whole lot easier in terms of setting expectations, whether it's with institutions or clients or advisors or anyone else who is putting money to work in these type of structures.
That's very helpful. And I saw that there are a lot of resources available on your website. So I certainly encourage our listeners to visit Allianz website if they want to learn more about these products or invest in these products. So do you generally encourage investors to start from the beginning of the outcome period and hold these ETFs till the end of the outcome period, or they can just invest anytime and look at what they can expect?
So, great question. What we see is that most investors like to invest right around that outcome period time. Sometimes it's a couple of days before, the cap and the buffer is being struck. Sometimes it's a few days after or a few weeks after. But you literally can invest whenever you have the need to invest. You don't have to wait for a reset period. They're efficiently priced. It's all market dynamics, so there's no arbitrage to be made, so to speak. You can just buy them whenever you have the need. What we've done to help investors, though, because we understand and appreciate how things change over time, for the 10% buffer and also for our 20% buffer, this is why we've launched 4 versions of the same thing. So we've launched the 10% and the 20% buffer with a January 1 date, a April 1 date, a July 1 date, and an October 1 date. So you have, on each quarter, you have an opportunity for a reset throughout all of our buffers in our lineup. That gives you like a calendar diversification opportunity if you want to. So you could literally buy equal shares of each one of those 4, depending on how much risk mitigation you're looking for. You can buy the 20 or the 10, or you can buy a combination of the 2, completely up to the investor. But that's part of the reason for why we have multiple versions of the same strategy. The only difference is that they run on different dates, but they all run over 12 months. So the April 1, for example, the April 1 fund runs until March 31st. So a full 12-month period.
So we know that nothing in the market is free. In fact, nothing in life is free. So since investors are getting downside protection here with these ETFs, they pay by accepting some cap on the potential upside. And you talked about that earlier. In addition to that, are there any other drawbacks to these ETFs? And are there any risks associated with these ETFs?
Not really. The risk is in the expectations, and if you understand what you buy and you know when you buy it, what the caps and the buffers are, where they sit, then there really isn't any. There shouldn't be. I should say there should not be any risk in terms of having the wrong expectations. The outcomes are defined. We're using flex options as the underlying to make sure we can execute and deliver on that outcome. It's also something that we have done as an organization within Allianz. We've managed these types of structures for decades, if you will, on the annuity side. So it's nothing that's new to us. We do it. We have our own trading team that's executing all this. Our own portfolio management team. It's what we do for a living. So that there shouldn't be any real drawbacks of the ETFs. The key is that you understand why you buy these types of ETFs and what the expected outcomes are that you're looking for. And as long as they match up with what you need and they're suitable for the investor, then there's really no drawback that I can see.
Yeah, I totally agree with you. It is very important for investors to educate themselves, know what they want, and be aware of what they are buying. So I also wanted to talk about the use of these products in a portfolio, and also who are these ETFs for? In general, should investors use these ETFs, or they are targeted for some particular class of investors?
Yeah, sure. We see primary, I would say, three use cases and types of investors. The first one, which is the dominant one, it would be for those investors that are nearing retirement or moving into retirement. That tends to be when investors take a closer look at their overall asset allocation. And it tends to be where you start to become a little bit more conservative with your equity positions primarily. And for many years and decades, every textbook you pick up about asset allocation will tell you that you move some of your assets from your equity allocation and you move them into your fixed income allocation. And then, of course, you can make it more complicated and you can buy all kinds of asset classes. And the idea is that you get diversification benefits from that. But at the end of the day, if you stick with the two core components of equity and fixed income, you carve out some of the equity piece and you put it into the fixed income allocation. That has become less attractive by quite a bit. Part of the reason for why you would want to do it is for the correlation benefits, which between equity and fixed income, those correlation benefits have been more or less obliterated over the past, several quarters now, with rates where they're at. And you've also had now reasons for moving from equity to fixed income because you're looking for income and yield. Well, you don't get a ton of yield or income from the fixed income market today unless you become more aggressive. And by aggressive, I mean you buy more risky fixed income, or you diversify into other types of asset classes. But as you do that, you get more exposure to the equity risk premium. So by default, you're moving closer and closer to an equity allocation going into another equity allocation, which kind of defeats the purpose to begin with. So we see long story short, we see a lot of investors moving, instead of moving into fixed income, they're moving some of their equity allocations into buffered ETFs, because that gives them protection on the downside. And in our case, again, it's either 10% or 20%. And in the case of becoming more conservative, You can put one allocation into the 10% buffer and then another allocation into the 20% buffer, and then increase the allocation to the 20% buffer over time as you become more risk averse. So that's use case number one that's quite dominant. The other one that's become interesting too, use case number two, it's for investors that are finding themselves in a position where they lose confidence in having the fixed income allocation altogether, providing the ballast point to their equity sleeve. And also those that, again, can't really get what they look from those less volatile asset classes, whether it's bonds or something different. They are in a way moving part of their fixed income allocation into buffer ETFs, and in most cases, it's the deeper ETF that we have that gives you 20% downside protection with some upside participation. Right now, for example, you could buy one of our funds, AZBA. It's our 20% buffer. It's the April version. It gives you rough numbers here, about a 5% return potential in case of equity markets going up, and it gives you the 20% buffer on the downside. So you can make some money, and you can feel pretty good about the level of downside risk mitigation at the same time. So we see a lot of investors using it as a fixed income supplement in this case. The third and final use case is for those investors that are still nervous. You look at the markets, you sit on cash. There's record, I think that it's well known, but record amounts of cash on the sidelines right now to the tune of 26 trillion or something like that. It's the biggest cash number that we've seen in the US. And for good reason. You look at the equity markets and you say, well, all-time highs, a little shaky, not sure where it's going to go, a lot of risk there. You look at the fixed income market and you say, well, rates might come up. That doesn't bode well for bond returns. And even if they don't come up and they stay steady, there's not a lot of yield there. So I'm not quite sure what to do with my cash. And a lot of investors, unfortunately, they just do nothing because that's the easy decision. And what we've seen now is investors being with these ETFs becoming confident enough that they can start to move some of their cash off the sidelines and back into the markets. And I say that also with the backdrop of the fact that we do surveys all the time within Allianz, and one of those surveys is pointing to the fact that 6 in 10 investors will freely admit that they're underinvested because they're nervous. They just don't know where to put the money to work, and they also freely will admit that they are underinvested to the degree that where they know that unless they do something differently, they will not achieve their retirement goals. So again, there's a lot of cash sitting there that's just being underutilized, and that's unfortunate. And we feel like the structure like the buffered outcome ETF can be really, really helpful in these cases, because again, it brings the confidence and the knowledge in terms of what you can expect from the outcomes to the investor.
Excellent stuff. Any other final thoughts for investors who are interested in these products?
Well, I would say you take a look like you do on any other ETFs. You want to make sure that you look for ETFs that are. You want to look at the expense ratios. We're happy to say that we have, since we're doing the portfolio management internally, we can offer a slightly lower expense ratio. And you also want to look at trading quality and bid-ask spreads. And as an organization with deep roots in the asset management community, and we also have the capability of holding those bid-ask spreads really tight with some of the relationships that we have on the market making side as well. So those are some of the things that I would just encourage anyone investing in these type of in ETFs period, but in particular also for the buffered ETF opportunities out there.
Excellent. That's all we have time for today. Johan, thanks so much for joining us.
Yeah, my pleasure, Nina. Thank you very much.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.